appreciate you spending some quality time with me. I'm make sure it will be a quality. I will have lots of stats, graphs, and statistics for you. We're going to talk about how obviously the bubble developed, how San Diego is comparing in all the craziness, because let's face it, this year, a lot of things happened and we went from hot to not, and this all in 1 year. Okay, so we'll talk about San Diego. We'll also talk about who was the surprise winner in which asset class, and I will give you 12 data points that you can analyze any market if you are interested in out of state investing. And then obviously we're looking ahead to 2023, what I'm actually investing in and I think is has future, okay? And I will give you some tips and hints what I would do and how I see the market. And what do I ask in return from you? Just subscribe to my YouTube channel, okay? My handle is Lenska Realty. And maybe give it some thumbs up and write a review. So with that, I gotta advance. So with that, we said thank you for joining us and being interested in improving your education and your investment skills. And we're going. This is for people who don't know me. I have a real estate broker license. I do ADU consulting and feasibility educational events, which I will mention later. And I'm also a rep for Crest Backyard Homes, which is a manufactured home dealer, okay? So let's take a step into a few bubbles we had, okay? After the bubble burst with the Dow Jones, it took 25 years to recover, and the average buy and hold investor never got back to even. The tech stock, after the dot-com bubble, it took about 17 years to recover. Bitcoin are now down well over 60% from their heights. Housing affordability is right now at the worst ever, as we noticed, and especially with the last few months interest rate increases. Now here's 12 days of Christmas or 12 years of Pricemas, okay? I coined this. So if you're looking at the peak in 2005 and 6, we were at 500,000. It took only 2 years to go down to, you see, there it is. Okay, didn't finish my slides. It went down to 300,000. Okay, I have to correct that, but can't do it right now. And then 2017 to go back up to 500,000. Why am I showing you this? Because there might be people investing in some of the market out of state that want to time it a little bit better. Now, this housing crisis in 2007-8 was a housing crisis. It was not a regular recession like we had many recessions throughout, the last 100 years, okay? So then we had this big back run up to about May. Let me see if I get my pointer going. Up to May at about 880,000. If you're not muted, please mute yourself for the time being, okay? So, and this was just today, okay? We're obviously a real estate group, but what I want to show you that it's a sea of red, except for the 10 year. And now, here comes the good news. Now, median sales price in November was about 750,000. The year-over-year appreciation right now is about 0. But if you're looking at it from a 3-year perspective, at least you're not negative, right? In the 1 year, like all the stocks I just showed you of stock market. So the 3-year is about 28%, which is still pretty good. But since we had that really huge run up, we could, and how many other markets right now are totally adjusting, okay? So we could see some more decline, but as you guys can see right now, San Diego already went down 10 to 15%, and that all from May to December. So how do we look in San Diego in November? We closed out with 752,000 at median home price, which is just, still a small appreciation. I think we'll close out December with about 0. The detached was at 880, still a slight uptick from last year. And for the median home price in attached, we ended up at 600,000. And as you can see, it was a 1.7%. The price per square foot was also a little bit up, but if you can see in July 2012, when you bought, if you would have bought there at $240 a square feet, you have some really nice appreciation. Days on market is obviously up. It takes about a third longer to sell a house right now. Pending sales are down, sold listings are down. Now, this is what I want to mention. When you listen to other people and they say, oh my God, we have pending sales 50% down. Now, what are we comparing it to? We're comparing it to last year. And last year was an anomaly. So was 2020, right? So we really should look at the 2019 to really kind of compare these numbers. Now, also, when you see months of inventory up 128%, it sounds a lot. But if you're coming down from a real low, we had practically 0.6, practically, what was it? 3 weeks of inventory last year. And last year, remember, it was crazy about the holiday season. So really, to these numbers, take that with a grain of salt. I hear it constantly. Oh, foreclosures are up 500%. Yeah, you got 5 foreclosures. 500% is 25, right? So it's all relative. And this is how you really need to analyze a market. So we went practically from 855. That was kind of the highest, 870. I saw it mid-months. And we're down right now to 750. Would I suggest to buy the dip? Yes, if the numbers make sense, okay? If you're paying $4,000 in rent, for example, and you can buy something that has future potential, I would go for it. I told you who was the winner. The winner practically is manufactured, modular, and mobile homes. The home prices have tripled in 10 years. Where regular houses and condos, they have appreciated, I think, about 2 to 2.5 times, okay? So I think manufactured homes, especially, are making a pretty big impact right now with where the market is going, and I talk about it a little bit later. So San Diego is still considered a strong seller's market. At least I put those in. So if you don't believe me, maybe you believe Altos Research, which is also, you can put that on your list of education. They have great webinars and great data. But how strong is the seller's market still in San Diego? So first of all, historically, an average house in the US costs around 5 times the yearly household income. And remember, I said to you, everything is relative. So during the housing bubble of 2006, the ratio exceeded 7. In other words, an average single family house in the United States cost more than 7 times the US median annual household income. In San Diego right now, it's about 15 times. Okay, so that's, and you see this in a lot of other cities, Boise, Phoenix, they're all far above and beyond their normally about 7 to 10 times. How hot is the seller's market, right? Here we go. 29 out of 90 homes close above list price. That was in the first week of November. Remember, people were crying and saying, oh, prices are down and there's no buyers out there. That is maybe in the 85% of the country. So I always say, numbers don't lie. And I pick a big closing day and I go down the list, right? Now, sometimes I don't use if it's 1,000 above the list price. So that was going on November. So a third still closed above list price, right? So for fix and flippers, there was no panic, right? Now, should they panic if they have too much inventory? Still, November, 32 offers. List price, original list price was $650. It got bid up to, I think it closed at $736. Okay, so that was still going on in November. But I forgot, where is the slide? I had a slide somehow. Oh, here, did I skip over that one? It looks like I skipped over it. 10 out of 68 homes closed above list price first week of December. So we lost from 33%, we went down to 15, okay? So this is a good indication how to price your fix and flips, for example, or if you're in the market to list your house, or if you're a buyer, you know that some of the houses are still in high demand. How do we notice before the market is slowing down? We look at the average sales price to list price. And again, in April, we were selling 106 to 107%. And look where we're now. And I printed out some of the other counties. I know it is the market update is specific to San Diego, but I did like Riverside a lot at some point for buy and holds. So San Diego is down, Los Angeles and Riverside County. So we practically went all in lockstep. Now, November 2022 inventory by zip code. And I remember I had a listing in Carmel, in Scripps Ranch, and an appraiser called me. So sometimes appraiser called the listing agent to just see, the demand and this and that. And I had a little discussion with the appraiser and he says, yeah, Carmel Valley went down overnight 200,000. So Carmel Valley is kind of this, it has, you guys probably can't see it, but inventory went up 600%. Okay. Also, like the 92131 zip code over 200, which surprised me was actually the Oceanside. Okay, because Oceanside is still considered. So I sometimes don't have, have a direct explanation for why suddenly in Oceanside, but Carmel Valley kind of made sense because the homes are just too expensive. Okay. So price reductions are actually flattening in San Diego. So we usually have about 30%. Kind of this is, and in the last years, obviously we had much less. We went up to 40%, but at least it is flattening out, which is surprising for the third quarter. Also remember, people make a big deal, oh, prices are going down and homes are taking longer to sell. Yeah, duh. It's always, normally it does in the last 2 months of the year, except for the 2020 and 21. Okay, but we had COVID. The whole market is out of whack and finally now kind of adjusting to the normal. I think I want to skip this one. Maybe to make you feel better, I'm just going to mention that, you know, price decreases in all the areas that were called the Zoom towns, like Boise, Phoenix, Austin, Denver, Tampa, Colorado Springs. They have the most price reductions, obviously, and also a huge increase in inventory, which is unusual for this time, because usually right now we have the inventory decrease, okay? So in December 2nd, 2022, the 7-day average of a median list price for a home in Austin was $695,000, down from the pandemic high of 900, call it a million in Texas, okay, in late February, and then the annual high of 850 now in May 2022. And remember, in Texas, you pay property tax 3%, okay? So, like I said, for you out that marked on my poll that you want to know more about out-of-state investing, Austin right now as today plummeted about 18%. And this is just an example. Phoenix, Salt Lake City, Boise, and I believe Seattle. So don't buy there now because prices are still adjusting. So now we're going to go a little bit into macroeconomics, because obviously we know the interest rate is the key driver, or I should say the treasury rate is the key driver for the mortgage rates. And now the discussion is, will prices go further down? It all depends on inflation or deflation. Inflation, yeah, deflation, and if we're hitting a recession, right? So for you that are not so in tune with it, this chart shows two different treasury curves, the 2-year and the 10-year. And so the 2-year is in blue, and the 3 months is in orange. So meaning dropping below the 0 rate is a very good indication that you will get a recession, okay? And when we go 2019, we went there, but then we had all the Fed stimulus and practically managed markets. We probably would have gone into a recession. But today, look at that area below here. It is pretty scary because it's steeper, it's longer than it has ever been before. So this is what economists, this is not what I think, this is what economists go by. So, and maybe if the yield curve is down, the economy is down. So the gray bars are the recessions, and this is when the treasury rate drops below the 0. I have a little video, but I think everybody is probably in tune maybe with this if you have later on questions. So what you need to remember for real estate investing is this is an indication for a recession. A recession doesn't necessarily mean real estate prices go down, because if you listen to my other market updates, I had a video where it kind of showed that some recessions, real estate prices don't go down. But it all depends on what type of a recession it is, okay? Because if the economy is going down and people lose their jobs, that's a different story. So again, we're trying to find if there are cracks in the real estate story, right? So I follow like obviously what rents are doing, what foreclosures are doing, what evictions are doing. So, and right now the US HELOC balances rising despite rising interest rates. So if you're paying more on your HELOC and you must be desperate to use them, right? Because right now, people sitting on their 3% interest rate, it's tough to refi. So they're going and borrowing against their HELOC, okay? And we just talked about where would we see more inventory, or how do we see that there is more distress in the market? So 8% of 2022 mortgages borrowers are underwater. In Colorado Springs, that figure is 30%. Remember all the markets I mentioned to you, Boise, Austin, a lot of people bought there in the last 2 years. And if prices going down 18% and the average down payment is 12, then people are underwater. Now, does that mean they're going to turn into foreclosures? No, because if your payment is low, you don't really care if you have equity. Now, when you care is that inflation is eating up your salary quicker, and homeowners were so used to still refi and get money out, right? Or lower their payment. And this is how the lifestyle was financed in the last few days. I can't wait for your comments and see if somebody maybe thinks differently. And so share of mortgaged homes in limited and negative equity positions as of September 2022. So I think it's pretty clear, right, that we have an increase in underwater mortgages. So there is some fine print here. I put in 19 having less than 10% equity. Okay, we'll talk about the investor story a little bit later, but maybe it's a good time to talk about it now, because if you're an investor, okay, and you have negative equity and you might want it to do maybe a year or 2 year hold or something, right? So you have to sell at a loss. Now, okay, let's rent it. So what happens if rents go down and maybe you're on an adjustable, maybe you're not, but this is how we can see that some investors are getting in trouble, especially in the Airbnb market. Some people had to do Airbnb to have positive cash flow. Yeah, if you would know that 40% of the Airbnb properties have been purchased in the last 2 years. Do I have to say any more? Okay, they have maybe, in order to make it cash flow, they do Airbnb. What happens? There's a lot of competition with the Airbnb. I have 3 investors that told me in the last 6 months that they have whether sold their property or they were lucky that they can do long-term rentals. Okay, so we could see whoever is getting in distress or can't keep up with the inflation to sell 1 or 2 properties. So how many homes have, obviously we want to know how many are in distress or could be underwater in San Diego, right? How many homes have sold in San Diego in the last 6 months? So we have, this is year over year, the 30,000. So we have about 15,000, but remember, 30% or 1/3 is usually paid cash for, even so that number went down. So we got 15,000, we got 10,000 homes, okay? And those have high interest rates. So we're probably seeing some of them as forced sales, right? Now, Fannie Mae, you know, has a sentiment index. They ask people, is it a good time to buy, to sell? Where are mortgage rates going? Obviously, buyers, it's the lowest. First of all, it's the lowest, 57.3 in November. As you can see, this is the lowest it has ever been. Okay, it's even lower than amidst COVID. So sour buyers and sellers equals a slowing housing market. Okay, so we've been practically in San Diego, we have been luckier than all the other areas. I would say we're probably a little bit more the outlier. Yes, we did drop, right? 12, 15%, but we adjusted. But what I'm with the low unemployment rate, they ask, are you concerned to lose your job? And this number was 70% in October, not concerned. And now it's only 57% that are not concerned. As you guys follow the news, we have a lot of tech layoffs, right? And other Goldman Sachs laid off 4,000 people. So we kind of now see a little bit the cracks in the what they call the good economy. And that's what you need to prepare yourself for, that it could get worse. Again, the inventory story will continue next year because we have the lock-in effect, what I call it. 85% of mortgages have an interest rate below 6%. The high share of homeowners who feel locked into their low mortgage rate is contributing to a steep decline in the number of homes hitting the market. And that's obviously, you know, according to Redfin. And they have really good data, so you can go on Redfin's site and also look up. So again, it's not so much about the equity, right? It is, can I afford my payments? And we'll get to a payment. Here's the interest rates now. Remember, everybody is harping about interest rates going up. It's 7%. They actually dropped a little bit. They were actually right around 6%, which if you look at it, yeah, the last 20 years where interest rates were going down, but 6% is still not a bad interest rate. So again, it's all relative. And we're probably back to this one here. Could we see a 5 handle again? And that depends on the interest rates and the Fed raising the rates again, because it does, which is kind of a little odd because they raised it again and mortgage rates didn't move up. So sometimes there is a little bit of a lag, which also in one of my other videos, it lagged. And then remember how it shot up suddenly in from May to about in 3 months, it shot up from practically 5 to 7. So sometimes it's hold, and then it's going up. So, but if we hit a recession, what does the Fed do in a recession? They usually cut rates, right? And then mortgage rates could go back down. Just to make a clear picture of what this actually means, that if you purchased a house in May at the heights of the market at 880, had 20% per down payment, 3% interest rate, your payment was about $3,000. If you bought the dip at 750 in November, put 20% down, You had to come up with less money, first of all, right? And you had 6% interest. So you were paying about $1,000 more. Okay. Now we know that the market broke at 5.5%, right? So the sales price would have had to come down to $640 to arrive at a $3,000 monthly payment. So could we see $640 in San Diego? I should take a poll now and check with you guys next year at the market update, but we could talk about a little later. Employment is obviously, if you don't have a job, if you don't make money, you can't qualify for a mortgage. I just want to tell you, yes, they say it's 3.2% unemployment, but this is what the government wants you to believe. So there are other numbers. How rosy is the employment? So I go by the U6 employment because it shows you the total employment. It does not figure out the people that have given up looking for jobs. We look at the labor participation rate, right? And there is obviously the big mystery, why is the labor participation rate is going down? And what is very concerning, and it has been going down. So some of the economists say, okay, because, you know, of our, the baby boomers retiring, and especially after COVID, they said, oh, shove it. And I look at my stock portfolio and I do well. I look at all my equity I have in my houses and I do well. So there has been a persistent economic mystery for the last 2 years. Where did the workers go? And if you look at that line, men between 25 and 64, they used to have a labor participation rate of 95, and it's down to 84. Okay, where obviously the women, it's an easy, I mean, they have been very consistent, right? And also the total number is 78. So where have the workers gone? Because obviously without workers, we can't be productive, push up GDP and grow the economy. So there is a new book out there that that's in the next slide. So a lot of people, if you look, this is another issue why we don't have, probably the demand is a little subdued because the student debt is in the way of people qualifying. Now, there is now a new way to qualify, and some of the student debt is not supposed to be used into your debt to income ratio, right? But look at this incline. So it looks like more people spending more money to go for school and go for more education. So the supporting evidence is found in the eye-popping growth of student loan debt, especially since the onset of the Great Recession. Okay, to be sure, some of that trend is accounted for by older cohorts heading back to school in hopes for improving their employment prospects. Remember also, when you follow the news, you have a lot of job openings. They don't match the education level that we have right now in this country. I always said, if we could teach servers to work on servers, on computer servers, right, then there would be probably a better match, okay? So the reason why I'm telling you all this is to kind of say, where are we getting these buyers from, right? Where's the demand coming from, and who is making the money to afford a house in San Diego? So like I mentioned to you before, some say, okay, this is the aging workforce declined, and therefore we have less labor participation rate. But remember, I also said men between 25 and 54, okay? So, and here in general, millennials, the disruptions of the pandemic, which triggered massive job losses as well as a spike in housing costs, have driven an unprecedented shakeup in living arrangements. In September of 2020, the survey by Pew found that for the first time since the Great Depression, a majority of Americans aged between 18 and 29 were living with their parents, okay? And here are the reasons: to save money, couldn't afford rent, to take care of them. I like living with them. I don't know who, it's still 30%. Personal health issues. I lost my job, afraid of losing my job. Okay. But these are not men. These are just millennials altogether. Right. So we know it's hard to get out of mom's basement, and you also do have to work. So coming back to the labor participation rate, going more to school, right? So here's the dark side of the positive employment number. Remember how we said men between 25 and 54? So this is kind of after COVID, that we do have the highest unemployment is men between 25 and 54, okay? And this is the book, Men Without Work. It's very interesting how our kind of socio work point of view has changed, right? And so we're missing a lot of people now. When they were asked why and how, it's a lot of people have disabilities, and 50%, I think, do I have that on here? 50% of them are on medications, okay? So some can't get a job because they can't pass a drug test, okay? So I'm just telling you this, that there is always more to the story, and obviously we're losing a lot of home buyers. So all right, we know that. Now, remember the iBuyers, okay? And again, so why we see more inventory and less demand is because the institutional buyers have purchased less. The median investors have purchased less in some of the markets. They used to be 33%, like in Atlanta, for example. Actually, Atlanta was even higher, but in the large investors, they actually only represented 8% of all purchases, okay? So we're losing kind of right now the institutional buyers purchase less, but also what we call the mom and pop investors are purchasing less. And that is when the iBuyers, some of them have totally closed their business. I think Open Door lost $1 billion this quarter, okay? And so we probably will see more layoffs there, and also see maybe some bankruptcies, right? So the iBuyers also, so much for technology and real estate, all their models of doing a fix and flip business didn't pan out. So none of the iBuyers were actually successful. And also profits over promises, obviously, when they make these offers to these people, it was questionable. Let's keep it simple on that one. So where we see more layoffs, we saw a lot of layoffs in the mortgage business, because refi business is down 90% and mortgage application are at the lowest levels right now. So I think they have ticked up a little bit in the last, since the interest rates went down again, it went up a little bit. So it's changing obviously week to week. Now, in order to figure out if prices are going more down or up, and it's all about the inventory, right? So we're not alone in this world with single family houses. We also have to look at the multifamily units, and the construction has been very strong, and also because of the pandemic demand, more permits have been filed, and guess what? They're all coming online starting next year. So specifically in September, nearly 900,000 units in buildings with 5 units or more, compared to 800 single family units were under construction. Okay. So do we have, please mute yourself. I know you get your chance to talk to me later. And single family units have decreased and in the last straight months. So we won't see, it depends on where you are. So definitely in San Diego, watch again one of my other videos, we have seen very few single family home developments in San Diego. On the other hand, the number of multifamily units under construction has increased for nearly the last couple of years. It's kind of maybe good news because at least rents will go down. Maybe if you're a buy and hold investor, sure, you have increased your rents according to the laws. Speaking of rents, because rents have beginning to decline, and I have seen it in San Diego as well. Okay, that they kind of, and again, November, December is maybe not the best, but rents overall have turned. And not only have they turned, so back to your out-of-state investing interested people. So we just want to mention that if you invest, it's unfortunately not only about rents and jobs and inventory. You also have to look a little bit at the political side, which means where rent control has not gotten traction or has gotten traction. So this is just a little bit of a rent control, largely failed this year, but expect it to reemerge in 2023. Okay, so here are the candidates. Take a quick peek if you need the list more. Or so you can watch the video again, and I'm going to upload it to YouTube. Okay, so now where rent control is getting more traction. So Arizona, Maine, New Jersey, and Nevada. Okay, Nevada is very close. I know also Las Vegas prices have decreased tremendously because again it was one of those straight up price cities. So and they're going to get back into it and see if they can now the good news is they only convene in odd numbered years, so it's a little bit stuck, but rent control getting more traction also in New Jersey, New York, Oregon, and we know California. Okay, so voters in 3 California cities, Pasadena, Richmond, and Santa Monica, approved rent control measures in the 2022 ballot, okay, with further expansion possible. Now, here in San Diego, obviously, there are new proposed renter protections to sync San Diego's tenancy laws to state laws. And what's on the what's going to change that tenants receive more relocation assistance. The just cause ordinance is that they get protection would start on day 1 of tenancy, not just after the lease is up or anything. So seniors and disabled residents who get no fault move out notices would have more time than other tenants to find new housing. So I find that interesting. And tenants who get a no-fault eviction notice would be given more time to remedy violations. Okay, all I see is if you're trying to get somebody out, good luck, and you have to have patience. Okay, so if you don't like San Diego, you go out of state. And so here are my 12 points to analyze a market when you go out of town. Okay, So you obviously look at employment. It's super important that it has a good base of employment and that there is not one major employer, because what happens if that employer moves out? It's going to destroy the real estate market. Did it have migration? Does it have migration in, for example, like Boise is a very good example. Everybody moved there. It was not the local people that pushed up the price. It was practically California inflating Boise's real estate market. Is there a lot of household formation? Median home price compared to the median income, right? So what is the ratio there? Inventory levels, is it a buyer's or seller's market? And how long does the property take to sell? Because obviously we want to get a good deal, right? How many building permits? Are there major developments that are coming out of the ground and will take down the price? The more inventory you have, price goes down. And obviously the interest rates, it's not so much obviously out of state. It has more to do if it's obviously an investment property or a multifamily, which means you look at the cap rates. And if I would buy anything right now, I probably would be very conservative, because going back to my prior mention about how many multifamily units are under construction, okay? And then there's what I call the happiness factor, which is because, remember, a lot of people can work remotely now. So is there sports, skiing, outdoor, you know, what does it have? Does it have a lake? Does it have some quality of life? So surprisingly, you see, I think it's realtor.com who thinks Huntsville, Alabama. They always forget to mention how hot and humid it is and how many bugs are there. Colorado Springs, obviously always on the list, and then Green Bay, Wisconsin. So you can go down the list and see if there are any houses where your cash flow, your cap rate is better than in San Diego. Now, back to macroeconomics, because we have, actually, I need to look a little bit at my notes to make sure I'm not skipping something over something. So we have, I find this, so I hope everybody agrees that with the pandemic and with Putin, I shouldn't say Putin starting, I should say with the war in the Ukraine, the world is changing and it's not the world as we know it, okay? And I think our politicians and the Fed and the central banks are not getting it. If you look at this, I thought it was fantastic, this slide. In 2000, America was the supplier for practically everybody except for, Asia and a few African countries. And look at 20 years later, now China is the supplier to the world, okay? So at the turn of the century, America was the dominant supplier for the world, but in just 20 short years, China has taken the title. And despite the naysayers, the trend continues. In the last 2 decades, China trade with Latin America and the Caribbean has grown 26-fold, from 12 billion to 315 billion. It also overtook America as a top supplier in Africa, Asia, Australia, Europe, and South America. What has it to do with San Diego real estate? You're probably asking yourself. I hope you're asking yourself. I think what it has to do is how our economy is growing, how good the jobs are, and can we afford the real estate prices? And a lot right now has to do with the reverse effect of the globalization. Because right now we're building factories in Arizona and stuff, so we're actually getting some of our manufacturing back, which is important for obviously independence and job creation. Now, speaking of job creation, the question is it going to be a great holiday sales, right? So when you look at the containers, they actually sail empty. And why I show this slide is to kind of prove that obviously the demand is not there, or businesses have ordered too much and they have already too much inventory sitting on the books. So which means what Peter Schiff thinks, the devil is here. Anyone expecting a soft landing doesn't understand the situation. There will be no landing at all. The economy will crash and burn, as I warned long ago. The Fed made a deal with the devil when it implemented the zero interest policy and QE to delay the pain. Now the devil is here to collect. For 20 years, we had cheap money, cheap labor, cheap gas or oil from Russia. All this has come to an end this year. And how the economy will adjust to that is a big question, which means real estate prices are up in the air. It could go either way. We're maybe blessed San Diego, we have biotech as jobs, but if the whole entire economy is coming down, so could real estate. So also real estate, and where is the demand? So the world has changed, and to a changing world is also what inventory is in demand. What I'm telling you with that is, don't look for the 5 bedrooms, 3 bath and think you can rent it to a family or something bigger, better. Just the opposite is actually. In 1960, just 13 American households had a single occupant, but that figure has risen steadily, and today it is approaching about 30%. So what does it mean? 2 bedroom, 1 bath, 1 bedroom, 1 bath. So instead of maybe putting your money, all 500,000 into one house and one big one, maybe that's definitely what I would do. Buy smaller units, okay? For households headed by someone 50 or older, that figure is about 36. So nearly 26 million Americans 50 or older live alone, up from 15 million in 2000. More than 60% of older adults living by themselves are female, okay? So smaller units, it looks like it is more in demand, and what has changed is we have been taught buy 3-2, 3-2, 3-2. So I say 1-1, 2-1, 1-1, 2-1, okay? So here's the real estate outlook, okay? Our market is dependent on what the Fed is doing, which is amazing, because if you think about that, this can make or break. Let's put it this way. The Fed already broke the economy and the making it in America, because if you don't have assets in with all this run up lately, you're just a little bit behind. And normally a good recession resets it, right? And people have a chance to buy a cheaper home, or, you know, to regroup, so to speak. But since the Fed or nobody wants to have any pain, you know, we're kind of very protective of that. So the question is, I think the conversation went from inflation now, which is also what inflation, 8%, really? Gas went up 100, food went up 50. You know, my indicator for inflation is Walmart, because when you buy this yummy fresh bread for $1, that is now $1.50. If you go to the $1 store, it's not the $1 store, it's $1.25 now. So we know where inflation is, okay? So if you have credit cards, did you notice? Did you look at actually, I have a very small HELOC, and I just looked at my interest rate. It used to be 2.9. It is now 6%, right? And what happens to all these people with credit cards? And don't get me started on car loans. So if all the interest rates are going up, you have to pay for it. So at which point are people at the breaking point, right? So, do we get a recession? Most economists say we're definitely entering a recession. It's just a question, how deep is it going to be? We certainly have a lot of geopolitical changes, and I could go on, but there are bright spots to concentrate. Where the deals, I think the opportunity is in life, work, play, and remote working. There are lots of new construction technology, and I'm a big fan of manufactured and modular homes. There might be some improvement coming when it comes to inventory, but we do have to look for declining rents. And I think the black swan hunting, we don't know. My biggest fear is that the Ukraine war is turning into a World War III, for example. Okay, we don't know what China is doing. Right now, they're going through all their COVID reopening. Okay, so we could see some more disruptions in that way. So I was talking to you about, and let me see if you guys, I'm a big fan of manufactured houses, right? So for example, you can invest in stocks of manufactured and modular homes. I actually sell quite a bit for ADUs. And I have a little, oh, there it is. It finally plays while I'm talking. And it saves you about $100,000 in construction cost, right? They're built to the same standards. And so instead of maybe buying a property where you pay, remember very beginning, I said about $560 a square foot, and you can build for $350, or you can get a manufactured house for $250. So this was just when they delivered the two halves, and they put it on a lot, which actually is an ADU. And so back to our investment strategies. If you have properties where you can increase your cap rate by adding an ADU, and some of the manufactured houses, they start at $140,000. Okay, so obviously you still need to do the utility and infrastructure. Okay, so this is a big. I think the ADU business is a very good investment strategy. If you find a good property that you are able to add an ADU and increase your cap rate, I would be okay with purchasing a property right now if it makes sense with your mortgage and you have a down payment. So this was one of our does it play? Okay, oh, here we go. So that was just a hyperlapse of, the manufactured home showing up here and that was a very tricky site. You see all the power lines here. They set it up so they would lift it right between the power lines. So here it goes. So whoop, and built and done and set. Okay. I think it's amazing. So there's some good opportunities with using that technique, or even investing in, in stocks. So like I said, it's Crest Homes I'm working with, and there we have sometimes tours to the factory, and also Back Porch Homes comes out with some new floor plans. So then, I actively invest in the co-living space, which is, I'm not sure if this will play. Oh, no, this will not play. Which is a property in San Jose del Cabo. So it's next to Cabo San Lucas. It's not exactly. And So that's where people for remote working, you know, and also partly vacation rental. So that's a very new niche that's actually coming, and a lot of the bigger developers are actually catching up on that property investment strategy. And oh, well, I don't know what time it is. I didn't time it at all. And oh my God, yeah, it's not too bad. More educational events. The third Saturday, we usually go out into the field and analyze properties for profitability. Right now, this Zoom call, because we have to get ready for next year, where are we going to put our efforts and what are we going to do? And I hope you didn't invest in any cryptocurrency, because the crypto corruption is there. Your money is gone. You have no interest or any ROI. It's zero, it's gone. But if you buy some real estate, you still can make some good appreciation, and the value never goes to zero. So that is kind of wishing you a happy new year, and thank you for hanging in there. And what the new year brings to you will depend a great deal on what you bring to the new year.